Hey, I'm Brian Godfrey, and I want to talk to you a little bit about income annuities because I think they're one of the most misunderstood financial products in retirement. It's not because they're bad, but it's because they're almost always explained incorrectly. Most people are led to believe that they're getting growth, income, and safety all in one, and that's not entirely what's happening. So, what I want to do is show you the real math behind income annuities, what you're actually getting, what you're giving up, why some people love them, and while other people regret the decision years later. So let's start with the biggest mistake that people make. First of all, they evaluate income annuities like it's an investment. They ask questions like, what rate am I getting? How fast is my money growing? What's the return? So that's the wrong lens to look at an income annuity, because an income annuity is not primarily a growth investment. It's a strategy to transfer risk. So you are transferring longevity risk, the risk that you might live too long and outlive your money. You're transferring that risk to an insurance company. So in plain English, you're paying them to make sure that you don't outlive your income. So there's really two types of income annuities that people get pitched, and mixing these up is where the confusion begins. So first of all, you have immediate income annuities. The way that works is you put your money in, the income starts right away. And that's the deal. It's real simple. Second, you have annuities with income riders. And this is where things start to get complicated. So you can get annuities, and we use annuities all the time. Okay, I never use variable annuities, by the way, because I believe if you're going to be in the market, which you are with variable annuities, then you might as well be in the market and not have the extra complexity and the extra fees that often are associated with variable annuities. So first of all, I only focus on fixed, and it's often fixed indexed annuities, okay? But in that fixed annuity world, you can get the plain vanilla, I call it, which is no extra bells and whistles attached, or you can get these add-ons known as riders. And in many cases, there's a fee that you have to pay for those riders. So when you're talking about income riders on annuities, you have two completely different numbers. And this is where it gets confusing for most people. First number is your actual account value. That means if you put in 100K, if you wanted to take withdrawals, which is not an income stream, that's another thing you have to realize. A withdrawal is not an income stream. An income stream is when you say, hey, I want to exercise, or I want to turn on that rider that I'm paying for, that income rider, and I want to make the income an income stream that goes on and on. That's an income. But most annuities will let you take withdrawals up to a certain amount. So the first number is your account value. Sometimes they call it the accumulation value. But that's real money. That's money that you could take withdrawals from based on the provisions of the annuity. The second value is the income value. Sometimes they call it a benefit base. There might be other fancy or confusing terms, but essentially it's an income value. So that value is not real money. You can't withdraw it. You can't transfer it. You can't walk away with it. It exists for one purpose only, and that is to calculate how much income you can take in the future. So when you're talking to some of these advisors out there or insurance agents, you're going to hear things like, well, this grows at 6%, 7%, 8% guaranteed. And right away, that already has people thinking, well, what do you mean 8% guaranteed? Nothing's really guaranteeing 8%. Well, that's because the 8% or 7% that you're being pitched is a roll-up number. In other words, it's an amount that gets applied to that income value only, not real money, the income value. So you put in 100K into this annuity, you have 100K that you can withdraw from, and 100K is the beginning income benefit base. So this calculated number only, not real money, this is the number that gets applied, the 7%, the 8%, but often it gets pitched, or at least it's misunderstood. And you're thinking, well, wait a minute, they're telling me that I get 8% growth on my actual money. That is not the case. So no, this is the first place where people start to think, well, wait a minute, annuities are too good to be true. Well, or I'm being sold something. Well, yeah, sometimes you are because of that misunderstanding. So again, if you put in, let's say 200,000, you're not earning 6% growth on that income or on your actual money that you could withdraw from. All that's doing is increasing the calculation that determines your future income stream. And so that's where people get misled, is because it sounds like it's an investment return, but it's not. It's a future income formula. So let's talk about what really happens when you start taking that income. And we'll use a simple example. Let's say you put in your $200,000. Later down the road, you turn on that income stream, that income rider, and then let's say you just get $1,000 a month or $12,000 a year. So here is the key question you need to think about. How long then is it going to take for you to get your original $200,000 back, not even factoring in any potential growth? So let's do a quick calculation. 200,000 divided by 12,000. It's going to take you 16 to 17 years just to break even with what you put in. And over that 16 or 17 year period of time, that's not including any growth that you would have gotten if you had the growth on the income rider, or I'm sorry, the income without the rider itself. So it's going to take you 16, 17 years roughly to get back what you put in, because the first chunk of money that you're being sent is actually your own money, right? You put in 200, you got to get that back. So the insurance company's advantage, or it doesn't show up immediately, or your advantage with the insurance company, I should say, doesn't show up immediately. Where these can be really good is when you live longer than expected. So that's where the math flips over into your favor. So this is why some people love income annuities. And frankly, they do have a place if you're trying to replace income. It's just often they're sold based on this growth number, which isn't real investment growth. Okay. And a lot of cases, what we find is people don't need an income annuity because they were looking for a growth annuity. But it sounds better if you're pitching a higher guaranteed percentage of something, right? So, but the upside to income annuity is that it does create something very powerful, which is a paycheck that you can't ever outlive. You'll never run out of money. So if you put your 200,000 in, let's say you collect it for 16 years, and then you live another 20 years. Well, now the insurance company is going to continue to pay you that income, 12,000 a year, for the rest of your life. And there's no market risk there. There's no guesswork, and there's no worry about running out of money. So if your goal is certainty, that can be really incredible. You really took a pile of money and created your own lifetime pension. Just like those of you who still are fortunate enough to get a pension, or just like your Social Security, it lasts the rest of your life. But let's talk about the other side, because this is where people get blindsided, right? Number one is loss of liquidity. So once you turn on that income stream, you lose access to the lump sum. In other words, you can't get you can't take any more of those withdrawals here and there that would be allowed if you hadn't turned on the income stream, because what you did is you traded, control for that income. So if your situation changes, that income often doesn't adjust. You're locked into that structure that you chose. So it's good that it's guaranteed, right? That because you'll never outlive it, but it can be bad because you're locked in. So and again, the biggest misunderstanding is where people think, well, I'm earning a 6% or 7% guarantee, thinking that that's interest on your account value, your real money, but you're not. You're receiving an income based on a formula, not growing accessible wealth. So in most cases, I'm going to lean towards not using an income annuity, except in those rare circumstances where we really need to produce a lifetime income. But here's what's something else that most advisors don't explain clearly. If your annuity has an income rider, that rider usually has a cost. Okay, and that cost is deducted from your actual account value, your real money, not the income value. I was literally with a lady yesterday. We looked at her. She had 2 income annuities. And her annual statement, we were just looking at it. Well, she got a 0 gain, which is fine because if the market was underperforming, which it wasn't in this period of time. So I don't know how she got a 0 gain, but that's a whole nother topic about how to structure the, investments, if you will, inside the annuity properly. But that aside, she got a 0 gain, but her fee on the income rider was $755. So that's real money that's taken off of what could have been in there to receive actual interest credit. So basically, you have a situation where your income base is growing, but your real account value may be flat or even declining, depending on performance and those fees. So this is where I see people often get hurt too. They already have an annuity. Then someone shows up with a new one with a higher income guarantee or a better roll-up rate, meaning maybe you started at 6% on this income value. Maybe next year it's 6.25, then it's 6.5, then it's 6.75. Or they give you a more attractive income illustration. But again, what doesn't get explained is you may be paying a surrender charge to leave your current annuity, or you're restarting a brand new surrender period. You may be giving up benefits you already built up, and now you're locked in again. Now, we do replace annuities when all the things make sense. So I'm not saying it's a bad idea to replace annuities across the board. I mean, you can't blanket statement everything, but the key is you have to understand all the details or have somebody that's willing to share the pluses and the minuses with you in just an equally clear explanation, right? Instead of just saying, hey, look over here, you're going to get this big income roll up, and kind of not telling you about the downside, the potential downside. So everything is a trade, and you just have to understand what you're getting, right? So that better income number might not actually put you ahead in the long run. It might just look better on paper. So the right way to evaluate an income annuity is not what's the roll-up rate. It's this: how much money, real money, am I committing? How much income am I going to get? How long before I break even? What flexibility am I giving up? And what happens if my situation changes? So it's not that income annuities are good or bad. They're a trade. You're giving up liquidity and control in exchange for a guaranteed income and longevity protection. So for the right person, that trade can make a lot of sense. But if you don't understand the math behind how it actually works, it's really easy to walk into something thinking you're getting one thing when you're actually getting into something else. And that's the difference between using these correctly or regretting the decision later. So if you want me to take a look at your annuities or help you evaluate or consider whether an annuity would be right for you or not, just give me a call. I'll put my number or email near the video, and we'll set up a no obligation review.